why are environmental risk policies important at banks, and why is it so important that folks put them in place and really, help lead their institutions by their policy and guide them through that?
Well, the short answer is that environmental contamination can cause an impact to the real estate collateral. In particular, commercial real estate is what we're talking about. And then it can also create direct liability for the bank under certain laws, particularly when the bank opts to foreclose and own a property. And as we go through the podcast, I'll be explaining more of the whys. So, not going to elaborate on them right now.
Great. So I guess the question that we get a lot is we deal with or speak to a lot of smaller institutions who may not even really have a policy in place, and they really just don't know where to start. So what would your advice be? I mean, what's the best place to really get started, and how do you begin? How do you form the policy, and then where do we go from there? We can kind of talk on that.
Okay. And these are sort of points to consider for big banks as well as small banks, as the big banks might be fine tuning their policy as they go along. But one of the first things to do is to discuss it with the bank's credit director and other senior staff at the bank. You want to figure out the bank's culture and what's the bank's risk appetite when it comes to environmental. So there are a bunch of different considerations that would go in with that, and some of them, not everything, but for example, the prevalence of regional contamination in your lending area. So are you going to get a lot of properties that have potential impact? What's the bank's niche for marketing to? Are you looking for loans that are largely retail? Are you going for industrial? You're doing construction lending? Sort of what types of issues are going to come up are going to be linked to the type of lending that the bank is doing. Then the strength of the underwriting that's done internally and the loan borrowers, their credit worthiness, also their guarantors, because that can help fix the loan if there's a problem during the life of the loan, can fix the issues. What's the bank's comfort with loss? Larger banks are going to be able to accept higher losses. A small bank, it could be catastrophic. And then what's the bank's typical exit strategies? Do you have a strong workout team? Um, and are you willing to foreclose and own collateral? And then lastly, reputation risk. How does the bank want to be perceived? So, as part of that, you'd establish, are there property types the bank doesn't want to lend on? For example, gas stations is something that I often hear small banks saying they don't want to do. Although, in fact, a dry cleaner is probably a higher risk than a gas station in many
Yep.
instances. So it's best to have one policy in the bank to avoid confusion, although you can tailor it slightly for different lines of business. Um, the the you is- I guess that's all I would say on that topic.
Yeah, risk tolerance is something important. I think you brought up a couple really good points. I think understanding the culture at the specific bank that you're working at is very important. We'll get into loan thresholds and things like that, but I think just understanding the culture, defining the policy to really match what the bank is trying to do and lend on is of the utmost importance. So once that piece is kind of established, you get into this decisioning process and sort of building out a matrix almost, if you will, of what sort of products and scopes fit where. And I know you have a lot of experience in developing matrix for various organizations that you were at. What's the best way to approach that?
Well, the written policy should include an environmental due diligence matrix. And we go through the podcast, I'm going to refer to environmental due diligence as EDD. And usually the matrix escalates the requirements for larger loans, and then also for property types that are considered to be more risky. So you'd typically have a chart that would have loan amounts on one side and property risk categories on another side. And then the bulk of the chart is going to be the corresponding EDD requirements. Um, the you might also have internal due diligence that's done as well as external or ordered from a third party. And the internal might be review of a questionnaire that's completed by the borrower. It might be a trained site inspection by a loan officer. It could be a form summarizing that loan officer or relationship manager's conversation with the borrower regarding key environmental matters. So those are kind of the internal type things typically that are done. Most of the time, somebody within the bank doesn't do the assessment types of things. Third party consultant is hired. And those types of third party reports and assessments would include a database of known state and federal environmental issues, like the databases that ERIS sells, historical property research, which include a variety of things. The most typical ones are aerials, city directories, fire insurance maps, and topo maps. And then there's three main types of assessments that are more report oriented. And a record search with risk assessment is an SBA defined type of assessment, and that combines the database and historicals. A transaction screen, which is an industry standard, adds a site inspection and limits the number of historicals and adds some interviews. And then a phase one environmental assessment, often called an ESA for short, includes everything that I just mentioned, plus some physical setting information, agency file review information, and interviews. But it's important to note there's not one size fits all. The tiers that a bank employs for their risk matrix might have tiers for half a million, 3 million, 5 million, or anything in between. But it depends on the bank's comfort level. Again, going back to what we were talking about at the beginning of what's the comfort level for the risk appetite and how much is the bank willing to lose in essence. The categories for property could be low, average, and high, or it could be sensitive and non-sensitive, which is something that comes from a list that the SBA publishes is typically what people use. And kind of as an example, a low risk might be a newer office or a multifamily building on undeveloped land, while the high risk category might be a gas station or dry cleaner. And typically, all high risk properties are going to get a phase one, regardless of the loan amount. So you need to consider in making that matrix, are you going to plan to look thoroughly at every deal? Or are you going to have a lighter touch for properties that are initially perceived to be low risk? And then you might establish a lowest tier level below which the EDD is not required, like maybe 250,000 is typically used. And I should mention that the SBA standard operating procedure does include specific EDD requirements. So you might have a matrix that's for your conventional loans and a different matrix for SBA. Um, a couple of last things to mention is the risk is not always apparent. I can't tell you how many times over the years a loan officer would come in with a property and say, oh, this is a clean property. Well, lo and behold, that newer office building was constructed on a property that was previously a gas station, for example. And another issue that's cropped up in the last decade is vapor intrusion. So the property may have risks for activities that occurred on site, or it may be from adjoining or nearby properties, which are migrating onto the subject property. And there's always going to be surprises. Activities may have occurred before offsite disposal regulations came into play. And then there also before regulatory oversight agencies were established. So sometimes the only way you can figure out the risk is to do sampling, and often that's called a phase two. Um, and so you'll decide up front, do you want to lend with eyes wide open by doing thorough due diligence at the beginning? Or do you want to take on more risk by finding out when that loan defaults?